Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is May 2nd, Thursday, the last stock pick of the day video for the week. Today we're going to take a look at Stanley Black Decker. This is out of the industrial sector. Let's jump right in. Before we get into the meat and potatoes of the video, if you could do me a huge favor, hit that thumbs up button down below if you are a dividend growth investor. Hit the subscribe button. Make sure you're subscribed to the channel. Join us, and if you're not, hit the subscribe button to join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever we put out any new content. I do these stock pick of the day videos Monday through Thursday whenever the market is open. I also do a portfolio update every Sunday morning at 7:30 a.m. So make sure your notification bell is rung so that you don't miss any of those future videos. And drop a comment down below. Let me know what you think of this particular video and Black & Decker. Is it in your portfolio? Is it one you're watching? Is it one you're avoiding altogether? And I really do appreciate everyone who has done that. It does really help a small YouTube channel like mine with the YouTube algorithm. The more you do those things, click the thumbs up, hit the subscribe button, drop a comment, hit the notification bell, and share with other people you think that might find value in the content, the more it gets the word out and spreads these videos far and wide to people who may not otherwise see them. So thank you so much for all of you who have taken the time to do that. Now, this is the Vested Interest stock screener. This is how I look at a company on a high level to see if I'm interested in investing. And just because it meets 5 of 8 or 6 of 9, if it's a financial company like a bank, does not mean that I'm necessarily investing in it. It just means it goes on my watch list and I do more of a deep dive into the financials. This is a high-level screener here, right? Just to get an initial gauge on a company. It is not a deep dive into the financials of the company to see how well the company is performing. That should be done on a deeper basis and would take more than the 10 to 15 minutes I'm trying to keep these videos to, right? There are a couple things here that I am thinking of changing. This growing free cash flow, I say last 5 years, which I look at some sources that go back further than 5 years, but on the videos we look at 4 years. So I may change that to 4 years. And then the other one, I was thinking of changing this maybe to 6 of 8 instead of 5 of 8 and leaving the 6 of 9 the way it is. But I haven't really put a final decision on that. So if you have any input on that, if you'd like me to change these to base it more on how we're going through these videos, because that is also, this screener is how I go through these videos. So we're going to run through this criteria in this video and look at it. So let me know what you think. Should that be 4 years, and should this be 6 of 8 instead of 5 of 8? Now back to the video, and if you want to know more about this company, check them out at www.stanleyblackanddecker.com. That's www.stanleyblackanddecker.com. That is their homepage where I pulled this information from, and it's probably very apparent what this particular company does, right? Since 1843, so they've been coming up on 200 years making tools. Right? Stanley Black & Decker has evolved, transformed, and revolutionized to support and serve the world's makers, doers, and protectors. Times change, our purpose hasn't. So they make and sell tools for construction, for home and garden use, right? You got Cub Cadet, and maybe you're not aware of all the different brands that are under their umbrella, but there is a lot of them, right? Cub Cadet, Hustler, Troy-Bilt, Rover, those might be something that you use if you mow your own lawns, or the company that you hire to mow your lawn uses. And then they've got a whole variety of tools that some of you might have in your toolbox, whether you're a construction worker, whether you're a do-it-yourselfer, whether you're just a tinkerer who has some tools out in the garage, right? DeWalt, Craftsman, Stanley, Black & Decker, obviously, Stanley Black & Decker, that's the name. Lennox, Irwin, there were a few others, but I didn't want to put too many on there where it got confusing on what all that they cover. But really, so you can see, like I said, the different brands underneath their umbrella are definitely known by most do-it-yourselfers, construction workers, or like I said, tinkerers who might just have some tools out in their garage. Now, the reason we're taking a look at them, down 7.53% on the day. We are talking about Stanley Black & Decker, ticker SWK. Closed out the day at $84.98. Looks like they're up slightly in the after hours here. 52-week range, $73.87 for the low, a high of $104.21. So they are closer to their 52-week low than their 52-week high. Market cap of $13.07 billion, a beta of 1.33, so they are more volatile than the overall market. Now, they did not have a price to earnings ratio. Now, you're going to see some of the numbers that will probably tell you why I believe that it's negative. EPS is negative 1.88, so not good so far, not off to a very good start. Not only is it very volatile, the price earnings ratio is negative, the earnings per share is negative. Earnings date was today, May 2nd, so I'm assuming something their earnings didn't fly with everyone. That is why there was a big drop today. Forward dividend, $3.24 paid out on the year. Dividend yield currently 3.53%. Ex-dividend date coming up June 4th. They are going to pay out June 18th. 1 year target, at least according to Yahoo Finance, where I pulled this information from, $99 per share. So they see some upside from here. Now, we're going to take a look at dividend yield theory to see if this one is potentially undervalued. To do that, we look at the 5-year dividend yield average of 2.5%. We compare it to its current 3.53%. It is higher, so that speaks to undervaluation. Dividend yield theory is inversely correlated. If the dividend yield is higher than its 5-year average, it speaks to undervaluation. If it is lower, it speaks to overvaluation. So in this case, Stanley Black Decker, at least according to dividend yield theory, is potentially undervalued with a margin of safety here. This is not good. Payout ratio 300%. That is certainly not good. That is screams to me that just like 3M just cut their dividend, this one might, if this continues, might have to cut their dividend as well. Or they're going to have to do something else, because you've got to have positive free cash flow to cover the dividend as well as pay down debt, continue to expand the brand, the company itself. So again, payout ratio not good. We're going to jump down and look at free cash flow. We want growing free cash flow over time, because typically if a company has growing free cash flow, they have growing dividends. And as a dividend growth investor, I don't know about you, but I certainly want growing dividends over time. We go back to 2020, we can see $1.6 billion in free cash flow. 2021, huge drop down to $144 million. 2022, back up to $1.9 billion. 2023, another big drop down to $852 million. So very cyclical, up and down, up and down. You can see they are repurchasing their shares, and sometimes their repurchase of their own shares accounts for some of these drops, but I'm just not seeing it. Yes, they had a big uptick in their repurchase of shares in 2021, but that was a huge drop in free cash flow. I don't know that that covers all of it. Big jump up in their repurchase in 2022, so they had a good year there. But again, significant drop down in free cash flow, as well as a drop in their repurchase of capital stock. So I'm not sure 2023 repurchase of capital shares accounts for the loss either. But overall, from 2020 at $1.6 billion to 2023 to $852 million, we are not seeing growing free cash flow. So that is not good. Now, stockanalysis.com is another site that I like. You pick any sites that you want. Just make sure you're picking more than one so you can make sure the information you're getting is accurate and up to date. Sometimes it takes these sites a little bit of time to update their information, and sometimes they just have the wrong information. So again, don't just blindly trust one source or some random guy on YouTube and buy something just because one source or some guy on YouTube tells you to. Make sure you're setting up your own criteria. You're learning how to look at balance sheet, income statements, and understand a business, or just stick to ETF investing, index fund investing, and pick a ETF like VU, which is the S&P 500, or VTI, which is the total United States stock market, or something like that. All right, 9 analysts that have taken a look at this, they call it a consensus hold. I don't even know if it's a hold. I might even be on the sell range right now, in my opinion. But low estimate of $80, which would be a 5.83% decrease from where it currently sits. Average estimate of $98.11. That's pretty close to what we saw with Yahoo Finance, which would be a 15.49% increase from where it currently sits. And if it happened to hit their high of $118, that would be a 38.9% increase. All the while, you could collect that, almost 4% dividend yield, 3.8%. It does have a nice starting dividend yield, but is the dividend in danger with that free cash flow being so high, the payout ratio being so high, and the free cash flow up and down like it is? We're going to jump into statistics here, see how efficiently this company is reinvesting its capital. To do that, we look at return on equity and return on invested capital. I like 10% or better for both of these. This does not meet the metrics. Return on equity, negative 3.3%. Not good. Return on invested capital is so bad they don't even list it. EPS forecasted growth, I like 5% or better. Again, nothing listed. I'm assuming they don't foresee any EPS growth, or it's negative, or it just hasn't been updated. But nothing was listed. Revenue growth, nothing listed either. So far, the numbers are not looking good. I can see why they call it a hold. And again, I might be even on the sell or a strong sell on this one, in my opinion. Let's jump over and look at the dividend real quick. So as you can see, they are a quarterly payer. Payout ratio not listed, though Yahoo Finance had it at 300+%. So again, not good. Dividend growth of 1.25%. So their dividend growth is growing, but very, very slow. 57 years of dividend growth. It's much like, 3M that recently cut their dividends. This looks like a company that may be in danger of that. Their buyback yield is negative 3.63%. We like positive buyback yield. So really, if they're getting a negative yield buying back their shares, they shouldn't be buying back their shares. They should be paying down debt. Shareholder yield 0.2%, not very good for you as a shareholder right now. Very, very low yield as getting a return on your investment right now, so not good. Overall, the numbers on this one do not look good. November 30th, 2021, they were paying 79 cents. Well, let's go over here. They do pay on the March, June, September, December timeframe. Again, going November 2021, they were paying 79 cents. They jumped it up September of 2022 to 80 cents, jumped it up September 2023 to 81 cents. And if they are going to continue this growth, I would anticipate September being the next time they raise it up. To me, they should not raise it at all. If anything, they should be looking to cut their dividend so that they can get their free cash flow under control and try to get a turnaround on this business. Not looking good. I did add this here. I had one comment on a recent video. They kind of said the videos were anticlimactic, not giving my final kind of opinion. I try to give you my opinion on what I think, whether a company is overvalued or undervalued, but we're just going to look at here. If you look at where they're at as far as looking through the vested interest stock screener, we understood the business. That's where we started, right? It does not have growing free cash flow over the last 5 years. It does have a growing dividend, even though it's slow. Dividend payout ratio of 75%. Nope. Check valuation based on dividend yield theory. It was potentially undervalued. Buy below current cost basis or within 15% of a 50. It actually might be within 15% of its 52-week low, but I left that. It's not in my portfolio, so it's not under my cost basis, and it's not close enough to its 52-week low. On this one, it needs to set a new 52-week low for me to even be interested. Return on invested capital, return on equity equal to or greater than 10%. Nope. Earnings per share growth. Nope. And I use this more for banks, so we didn't look at price to book on this one. So it would not meet the screener criteria. It would not even make it on my watch list. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So drop a comment down below. Let me know what you think of Stanley Black Decker. Like I said, is it in your portfolio? Is it one you're watching? If it is in your portfolio, are you concerned with the metrics? And what did you think of today's earnings call? I'm sure that it was not good, and that's why they dropped a bit the way they did. Again, numbers don't look good on this one. I love Stanley Black Decker. I have a buttload of Craftsman tools in my garage. I mow my yard with a Craftsman lawnmower, or I'm sorry, DeWalt tools in my garage, and I mow my yard with a DeWalt lawnmower even. So it's not that I don't like the tools or the products or the company. It's that the metrics, at least on a high level, I'd have to do more deep dive into the financials. But to be honest with you, on a high level, it just doesn't look good enough for me to even take the time to do a deep dive into the financials. Again, let me know what you think down below. And if you have a company like Stanley Black Decker you'd like me to cover on the Stock Pick of the Day series, go ahead and drop in the comments, and I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion in investor, educational, and entertainment purposes. Investing involves risk against money. You should never invest any amount of comes losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel certified financial advisor.